Hello and welcome to Taking Stock for the week ending 25th of May 2018, where this week our Head of Research, Kien, Trinh, and myself, Elio, stream you all things share market. Hello, Kien, and thanks very much for joining us again this week.
Thanks for having me, Elio.
Hasn't it been a great month in the market, Kien?
Oh, it's been a stellar May, hasn't it?
It certainly has, and those that sold in May and went away, unfortunately, you'll be coming back and buying at higher prices because it has been an exceptional time, not only for the broader market, which is up some 1.7% so far month to date, but also for our star stocks, in particular our growth focus, that is our star growth and star income stocks, where the outperformance of the market thus far this month has been around that 2% mark. So it has definitely been the cycle for quality businesses, Ken, and that's obviously something that yourself and myself through our various communications have been talking about for quite some time. But more on that in a moment. Let's start off first with the advocacy program. So just a reminder, folks, to share the good things in life. There's no better time to do it than right now, coinciding with our end of financial year sale. There are rewards for members who are able to share the benefits of Stock Doctor with a like-minded friend, family member or colleague, and they decide to join Stock Doctor. So please do click on the tile on the homepage in order to learn a little bit more about that. But Ken, let's go straight into the stocks because there is a bit of news this week. Aristocrat, still currently under review, but I tell you what, it was a good result.
Yeah, it was quite a good result. Remember the acquisition that they had just late last year and also early this year with Plarium and Big Fish going to the social media scene. So the result was above expectations, and analysts were seeing updating their forecast by about double digits. The run rate for the acquisitions has been positive. It's been better than expected as well, and that's the only thing we'd like to highlight is the falling operating cash flows. All right, and the cash flows have fallen mainly because on the back of the increase in working capital, also higher tax expenses and acquisition costs as well. So we just got to watch that because that could affect the financial health of the stock. But they've come back and they've reiterated guidance for double-digit NPAT-A growth, so NPAT-A just before amortisation for this year. Forward PE of around about 25 times isn't too demanding.
Yeah, no, and look, you highlighted there, they've been growing very aggressively, but we need to assess now whether that's had an impact on financial health. Have they stretched themselves a little too thin? So they're under review at the moment, but stay tuned for that. Another one under review because, geez, they're making a very big acquisition, and that's Reliance Worldwide, who's buying a company, John Guest. Are they the best?
If you're looking at Reliance Worldwide, remember they have that push-to-connect plumbing product, right? But it's brass.
Brass, right? That's right.
But with these guys, John Guest, right, they use plastic, right? That's the key differentiator. They've got higher margins, right? But the question is whether this price they paid, which is around about 1.22 billion, is quite a lot. Remember, it's in a different jurisdiction also, so that's also a huge risk. They're paying roughly about 12.4 times EBITDA, okay? To us, it looks quite expensive, right? But we just got to be mindful it's a higher margin business and the company expects it's going to be EPS accretive in the coming years, so FY19. So hopefully that will play out. We just got to be mindful that they've reaffirmed their full-year EBITDA guidance as well.
Yeah, but the acquisition is quite large. It's around a third of what Reliance is actually currently worth, or half, sorry. It adds basically a third to the business. So, look, we're still doing our reviews there and we'll have our findings in the not-too-distant future. Of course, we never like saying goodbye to star stocks, Ken, and those that haven't been in the portfolio all that long, but that's part of being a disciplined, proactive investor. So Treasury Wines, we had to remove them, didn't we?
Yeah, with this stock, remember, we've just got to be disciplined and objective when we're removing stocks. And with this stock, remember, we included it in November 2017 at a price of about $15.83. But given the underlying risks, and the risks are quite large, right? It's quite significant. You've got supply chain issues. Remember, there's been talk of an oversupply of the lower priced wines at the moment, and that could result in heavy discounting. Now, remember, in 2013, this also occurred for Treasury Wines.
The California Wines debacle.
Yeah, in the US, there was huge oversupply, and then they had to write down around 260 million inventory. So we just got to be mindful of that. The other issue with these guys is also this the export delays. Remember, China's customs, they've changed their regulation, right, in April 2018. And so that's kind of led to some export delays in our exports, especially in the wine space as well. So we just got to be mindful. And when you look at the valuation on treasuries, it's trading at about 35 times PE. So it was quite expensive. So we believe the market wasn't factoring in these risks, so we decided to remove and err on the side of caution.
Yeah, no, we did. And look, that California debacle, which saw them breaking all the barrels, led to the party of a lifetime, of course. No, look, on a serious note, though, Kien, Nanosonics. Now, Nanosonics has been a star stock which has, come under some pressure in recent times. And as part of our assessment of active risks, we engaged with management and actually had a meeting with them. So would you care to share with everyone what you were told in regards to how Nanosonics is tracking at the moment?
Yeah, definitely, Elio, especially after what happened with Medical Developments, MVP. If you can recall, with these biotechs, what you see is quite lumpy cash flows, and there's huge risks in the short term. And so we wanted to have a look at Nanosonics because it's currently recommended in our star stock universe, right? But the thing with Nanosonics, remember they've got a key product, right? Trophon, right? And they've just released Trophon 2.
That's right.
And one of our concerns is that, one, there's a potential inventory write-down. So because of Trophon, the existing, if you release a new product, no one's going to buy
the old one.
Right? But we did talk to management, right? We want reassurance from management. And they mentioned that in terms of, the possibility of the inventory write-down, it's quite small, mainly because they can still sell it to other markets as well, right? At lower cost or lower margins, but not as significant. The bigger risk for Nanosonics is the GE, right? The relationship with GE. Now, GE, they're reducing the headcount of staff from about 5 to 1 over the coming year, right? Now, Nanosonics, they're also increasing their sales force as well at the same time. And the thing is, the risk is that the increase in sales force from Nanosonics, is it going to be enough to offset the impact of GE decreasing their sales numbers? So that's something that we need to be mindful of. Also, the breakdown in GE.
Yeah, I was going to say, so what's that relationship like then with GE and Nanosonics now, Ken?
Yeah, the relationship's still very strong, right? But they've changed the contract around so that in the second half 19, what you'll see is that GE are not going to, have the margin benefit from the sale of the consumables. The consumables is quite a high margin business, but Nanosonics come back and said, we want to take control of that. We're going to sell you the consumables at the full price. And if you want to, you can add a bit of margin to yourself. But I believe, and we believe that GE still wants to maintain that relationship. They want to maintain the full service offering, for their clients. And so that's a key risk. The risk is that GE could go off and also build their own products, right? Copy a patent or whatever, but that is a risk in itself that we're watching, because that's the only reason why they'd leave the relationship. But we're mindful of that at the same time. And the other key risk for Nanosonics is the short sellers. We've noticed that over the course of the year, short sellers have increased to roughly about 13 times or 13% of the total interest. So the shorts are onto this stock right now, and so we're mindful of all these risks, and we're in deep discussions right now on what we're going to do about it.
Look, great insights, Ken, and I'm sure everyone appreciates it. And as you would have just seen just then, all the active risks that Ken alluded to are in the strategic comments. So you can just go there for any stock, not only in Nanosonics, but any company that's under a bit of pressure at the moment. Will obviously be on top of all those active risks, and you can have a little bit of a read of that in the strategic comment to see if it is likely to impact the company moving forward, and then you can make a fully informed investment decision as to its relevance and appropriateness for your investment objective and your tolerance to risk. All right then, Ken, it's now time for our stock of the week, and it's a stock that many long-term members will know I've got a bit of a man crush on. It's Monadelphous. Their code is MND. Tell us a bit about it.
Thanks, Elio. I mean, it's a higher quality mining services company that's diversifying their revenue towards the infrastructure space and also energy space as well. Now, the thing is, if you have a look at their revenue breakdown, they are still exposed to energy. They've got about 56% exposure to oil and gas, around 13% to infrastructure, and around 25% to minerals. But if you have a look at their financial health, they've got very low debt, very good cash position, although their cash flows are expected to fall this year though, okay? And if you have a look at their recent performance, they've improved on profitability, but there's been a reduction in the EBITDA margin, okay? And that's quite deliberate because they are diversifying towards the infrastructure and maintenance space,
that's right.
which is a lower margin business.
Correct.
So
but more predictable.
More predictable and defensive. Yep. So cash flow is down due to timing. The maintenance work is expected to strengthen. Okay. It currently comprises about 45% of revenue, but that's expected over the next year or two to increase to above 50%. Growth is still expected to be strong for this financial year. Revenue growth is expected to be about 30%, but that's just due to construction activity in the LNG onshore facility. That's not expected to be repeated. But despite this, right, the outlook for the resources sector, that's improved. And there's also improving demand for the maintenance and services as well, and that's expected to strengthen as well. So our Lincoln valuation's around about 1461, so the share price has come down towards that level now. I mean, there's really no fundamental reason why the share price has come down apart from, just a bit of uncertainty. We're watching the cash flows because it's, for this business, you need very strong cash flows, to tenor for those businesses. But in the meantime, we believe the story has good conviction at these levels.
And always the ongoing risk of the commodity cycle, given that they're neck deep in it. Obviously, that's going to play an impact with price, but seriously, with Mr. Valtieri at the helm, and if there's anything in engineering he doesn't know, it's not worth knowing. And hence why Monadelphous MND is a very worthy stock of the week this week. All right then, Ken. This week's question of the week relates to golden rule number 6, and that is, how important is liquidity in my portfolio?
Yeah, it's quite a huge risk, Elio.
Yeah, it is.
In light of our removal of MVP or medical developments, which was quite a illiquid stock, it's quite a useful question. Now, if you're interested in a stock and it's quite illiquid and you want some exposure, we recommend the first thing we look at is the average volume over the last 3 months, okay? And you just got to compare that to your overall portfolio exposure. Now, within your portfolio, though, say for instance, the absolute minimum that you should have is roughly about 5 times the exposure,
the minimum,
right? So what we're talking about is if you have 10,000, say you want to invest 10,000 of that stock in your portfolio, right? You've got to look at the average volume of that stock, and it needs to be at least at utmost minimum 50,000, right? Yep. But our preference is to be 10 times, just to have that margin of safety earlier, right? The other thing you can do is also, look at your position sizing as well, and this is a huge risk as well because you can't get out of a stock if it's too liquid, and work out what you're willing to lose relative to your stop loss and work that way as well.
Yeah, so, taking that relative positioning and understanding the average liquidity is very important when it comes to making a decision. All right then, folks, that's all we have time for this week. Just a reminder, next week we have Fisher & Paykel reporting. So, and a reminder, of course, you can go into Stock Doctor under the corporate calendar and see all corporate events as well as Lincoln events that are upcoming. So Fisher & Paykel due to report next week. We also have an update of the Stock Doctor Investors Network meeting groups across the country. That'll be coming at the end of this recording. But for now, thanks, Ken.
Thanks, Elio.
Thanks for watching, everyone. Have a happy, healthy and prosperous week.